Good morning and welcome back to another East Capital webinar. For those of you who don't know me, my name is Massimo Grassotti and I am part of the investor relations team here at East Capital Group. Today we are joined by East Capital's CIO and partner, Grapengiesser, who now finds himself in Dubai and is joining us to talk about the outlook that we've just posted and a little bit about what we here at East Capital think for next year. So Jacob, welcome. Thank you very much.
Thank you.
So if we dive right in and if you could give us a little bit the broader picture about this fat and flat and a little bit what we see for markets next year.
Yes, thanks. So the big question for markets next year is what's going to happen when global liquidity slowly will be withdrawn. So if you look on the chart, you can see that since the financial crisis in 2008, central banks have been increasing the liquidity in the system. If you look at the G4 central bank's balance sheet by some 400%. So it's just an enormous amount of money that has been effectively printed by the central banks and pushed into the system. Equities as one of the most risky asset classes has been benefiting from this, which is, quite natural, I would say. And if we look since prior to COVID, the amount of liquidity in the system has increased by 72%. So the gray area is the amount of global liquidity, or defined by G4 central banks balance sheets, and the blue line is just the MSCI All World Equity Index. As you can see, there's a pretty high correlation between the two, and the last bit here of the chart, you can see that equity markets actually have already started to come down ahead of liquidity coming down. For next year, we are looking at some $2 trillion being removed by central banks. Half of that is from the US, 1.1 trillion. And that corresponds to something like 8.5% of global liquidity that will be withdrawn. So I think this is a bit of a challenging backdrop for equities. The question is perhaps, how much of this is already in the price, and I'll get back to that. We are also moving from TINA to TARA. So TINA means there is no alternative. There is no alternative to equities, meaning that all of this money was being channeled into equities. And TARA means there are reasonable alternatives. So as you can see here, for example, if you just look at the dividend yield of the global index versus the yield on the global bond index, you can see that for the first time in more than 10 years, the bonds are now yielding more than equities. Again, that's because you had all of this central bank kind of supporting the credit markets and buying back bonds, low interest rates, etc., which is why bond yields were very low, but now they're starting to tick up above equity dividend yields. I think this is probably a healthy sort of correction of the financial system. I think it was perhaps a bit overdue. And if we take a slightly longer term view, if you look on some of these strategists and the likes of Peter Oppenheimer's definition of markets, they speak about super cycles and so-called fat and flat periods. We clearly were in a super cycle, and the question is if we're entering this fat and flat period now, and that just means that markets don't go up by definition, they go sideways. And that is obviously the environment for a stock picker, an active manager that can kind of buy the good companies, maybe cheap companies, and vice versa, stay away from the worst managed and perhaps too expensive companies. So this is probably I think the period we're entering now, and I think our advice in general would be that you should be aware of this. You should be aware that markets might be volatile, but there will be alternatives, and probably just look at valuation as a guiding factor. I think it's easy to say that you should look at the valuations, but I really think that's the case. So we look at our sort of aggregated portfolios. What is the earnings growth? What is the PE? And I think that should be sort of the guiding indicator or guiding light for investors, whether or not, you know, to invest into a certain asset class or certain kind of equity portfolio.
Oh, that's great. And then you touched on valuations there, and I'd like to get back to that in a little bit. But first, I do want to bring up, you know, November saw one of the best months in emerging markets in a long time. And we've had clients ask us a lot about with this, you know, momentum coming from there, China reopening. Could this be a start to a potential shift in sentiment towards emerging markets as a whole?
Yeah, so November we saw both on the equity and on the bond side, one of the best months ever, 15% up. The reason for this is that possibly China is opening up. We have two colleagues based in mainland China, so we are getting sort of on the ground reports from them. There has been some reports that up to 50% of the Beijing population have been exposed to COVID. And that will be huge, right? Because that means that you are sort of at the peak in terms of number of infections, and then, you know, things go down, and then actually then, I mean, number of infections go down, and then you can start opening up the economy. I'm not convinced it's at 50%, but let's say that, you know, 20 to 30% of the population in both Shanghai and Beijing have been exposed to the virus. It means that in 1-2 months, perhaps 2/3 will have been exposed, and then you know, you will be out of it, at least out of the first wave of it, and that would be a huge thing for China, because then they can open up the economy. There's probably 4 to 5 percentage points that the Chinese economy can grow on the back of this sort of pent-up demand and economy opening up. So that would be a very, very large thing, and China is 1/3 of emerging markets, and hence it will sort of push all emerging markets up. I think another observation that we can have is, you know, I think there's a certain home bias for most investors, right? You know, I'm Swedish. Swedish investors think about the Swedish economy and market. US investors think about the US economy and market. And it's fair to say that both Europe and the US is probably heading into recession, right? I mean, we are at the end of the cycle, as it's called. Whereas for China, we are opening up. We are entering into a phase of higher growth. And that's probably true for most of Asia as well, that, you know, we're in a different point of the cycle compared to the US and Europe. For European and American investors, I think it's a bit hard to kind of grasp, but that's really how it is. So if you look on a globally diversified portfolio, you probably should have a bit of Asia in it and a bit of emerging markets, because then you also diversify your exposure to different parts of the cycle, which is very, very important in terms of equity market performance.
You mentioned there, which I think is, you know, leads us right into the next point, is that emerging markets are too big to ignore, I think, in that sense, right? And we talk a lot about Asia as a whole, but we talk about China even more. But what we do tend to sort of forget to talk about, which is what we've heard a lot from clients lately, is India, which does make up about 16% of our GEMS portfolio. It's added a total, you know, close to 240 bips of alpha this year. What can we expect from a market like this going into next year?
Well, India has been doing extremely well for the last 2 years, and I think the real reason is that the Asian emerging markets typically, and this is India, China, and some of the ASEAN markets, they were growing at this very high rates, you know, 6-7% GDP growth year in and year out. That's why you got very nice returns on most things you invested into, even though valuations were relatively high. So now, of course, the picture is more complicated, and maybe, you know, China might open up this year, or sorry, next year, 2023, but that probably will trigger higher than normal GDP growth. But the new normal for China in a regular year, again, not in a year when they will open up, is probably 4.5% GDP growth. That's not that high compared to the 6-7% that we typically saw for China. Whereas for India, if you just look on the IMF forecast for next year, they will grow at 6.8%. So for India, it's, you know, it's the only really remaining emerging market that is keeping this very high pace of growth. Having said that, and because the market did do very well, valuations are very high. I mean, many companies are 40, 50, 60 times earnings. But we've been very active on the Indian market, and we found plenty of fantastic companies with valuations at less than half or even a third of those valuation levels. So I think it is a stock picker's market. It's a big country, it's a big market, and yes, many companies are expensive, but you know, if you really dig and search for these good companies at lower valuations, it is possible to find them still.
I think that actually brings us perfectly into, you know, you mentioned valuations a little bit earlier, and I see that we actually have a question here from somebody calling in about inflation as a whole. If you could talk a little bit more about inflation as a whole, a little bit where we see that going, as well as valuations. I mean, we know emerging markets trade at a big discount to developed markets. Could you discuss a little bit how we forecast this for next year?
Yeah, so I think if we look on, you know, if we take the big picture here, inflation will come down very rapidly. There's a lot of kind of high base effects. Here we're just showing the cost to transport a 40-foot container from Shanghai to Los Angeles. It's just one of those kind of key routes, right? So the price went up from around $2,000 to $12,000 during COVID, and now we're down to $2,400. If you look on steel prices, they are down 60% in the past 12 months. If you look on oil prices, well, they peaked at around 120, right? And now we are below 80 for Brent. So a lot of these things sort of are coming down, and the base effects will be kicking in, especially then for oil in February, March. So, you know, maybe we have seen peak inflation, maybe we see it, you know, in a month or two. It depends a bit in which country we look. But it's very certain that, you know, in a couple of months' time, you will see inflation coming down quite rapidly. And I think that's, of course, you know, the markets are aware about this, but it's still going to be positive headline news. So I still think that this will be a positive effect for markets. And if you combine that with more talks about growth being revised downwards, it means that central banks can stop hiking rates, and there would even be some talks about cutting rates at some point, right? And then so the whole sort of rhetoric will change, because now it's only talk about, you know, how much more will central banks hike rates, then, you know, you'll talk about no hikes, and you will start, I think you will start to talk about when they will cut rates in 3 months from now. And the market certainly will like that.
Yeah, well, let's hope so. We can't forget to mention also frontier markets, another one of our strategies here at East Capital. Markets that are decorrelated one from another and that have continued steadily this year. What can we expect moving forward there?
Yeah, as I said, I think, you know, we are in this kind of fat and flat period in terms of markets. So I think it's up to each investor to really find the sort of the portfolio that they think are attractive. I'm not saying it's easy, but if you, for example, look on frontier markets, if you just look at the index, it's trading at 8.4 times earnings with 8% earnings growth. Earnings growth is typically around 15% in the long run. You can say for frontier markets. This is the lowest valuation level we have seen in 10 years. again, I'm not saying they will go up tomorrow, but if you take a longer term view, if you invest at a 10-year low in terms of valuations, well, that's probably a good entry point, right?
Absolutely. No, I think it's always great, and they are markets that tend to be overlooked, but as you say, they are still interesting nonetheless. Now, just last question before we round up here. If we do take a look through an ESG lens, our GEMS fund being Article 9, there's a lot surrounding that. We recently had our Chief Sustainability Officer, Karin Hin, at PRI in person in Barcelona. From an ESG perspective, how do we plan to push this further? What can we expect next year?
Well, in what we can expect next year, I think, first of all, if we look on the valuations, I just wanted to bring this up, right? So I think if you look on the valuations, emerging markets are at a 1 standard deviation below 10-year average. Again, maybe frontier markets is even cheaper, but for emerging market, it's going to be about China, and if China opens up, it will, push all emerging markets up with it. And if you look on the US, for example, it's basically trading in line with 10-year average. So this is kind of hard to see any upside there.
Yeah, absolutely. Jacob, thank you very much. Any final words?
No, I mean, maybe what I can mention, I mean, if you look on our focus a little bit, we keep on focusing on renewables. I think the energy crisis in Europe has been further accelerating the demand for renewable energy, especially solar power, because it's quite easy and quick to build. And the amount of capacity additions in the next 5 years will be the same as you had in the past 20 years, and maybe even these estimates will be surpassed, right? So yeah, completely explosive demand, and even if you're in a bit of a boring kind of time for equity markets, this kind of whole sector and theme is certainly not boring. And here you are seeing this kind of explosive demand. Valuations all over the place, admittedly, so you need to be very specific about what stocks to pick, but this is a key focus for us.
Jacob, thank you very much. And as you say there, if we do enter this fat and flat period, it's exactly as you say, that it is important to be active the way that we are, to be stock pickers the way that we are. So hopefully we're looking at a good 23 from that perspective. So Jacob, thank you very much for your time. I appreciate you calling in from Dubai. I know you're busy, and hopefully we'll talk to you again soon.
Yeah, thank you very much.
Thank you to everybody else who called and dialed in. If you have any questions, please do not hesitate to reach out to any of us here in Investor Relations, Raise Capital. And until we speak again in hopefully January, wish you all happy holidays and a prosperous new year. Thank you.